So, hey, thank you all for coming to this meeting. Have an opportunity to listen to Bryan. Bryan Lapidus, FPAC, is the director of the FP&A practice at the Association for Financial Professionals, and we're grateful to have him here today. I guess I should have introduced myself. I don't have a slide. I should have talked to Bryan before the meeting. My name is Pat Hafford, and I'm the president of IACBE. And just delighted to be here and looking forward to hearing what Bryan has to say. He has more than 20 years experience in the FP&A and treasury space, working at organizations like American Express, Fannie Mae, and private equity owned companies. At AFP, he is the staff subject matter expert on FP&A, so that should be interesting today, which includes designing content to meet the needs of the profession and helping members stay current on developing topics. He also manages the FP&A advisory councils in North America, Asia Pacific, as well as Middle East Africa. I'm going to let Bryan now take over and walk us through, talk a little bit about Association for Financial Professionals. They are sponsors of ACAM this year, as well as partners with us, and we're hoping that this relationship helps benefit our members as well as our students. So, Bryan, it's all yours.
Great. Thank you, Pat, for the kind introduction. Hello and welcome. I'm really glad to be here with IACBE and with you. I just looking through the chat, I see Edward in El Paso, I see Kristen in Topsail, Andrea in Virginia, we've got Denver, but also I have to say, Leela in Guam, at the moment you're winning for furthest away to attend. But that's what's great about a Zoom world is we get the chance to hear from each other, to learn from each other wherever we are in the world. So thank you for being here today. The topic that we have, getting Agile right for finance. And I gave it a subtitle of how CFOs deliver value today. And I really do believe that these two are really intimately linked. The CFO function has the ability to inhibit or accelerate agility as they evolve their roles from scorekeepers and accountants to really partners with the business and bringing that finance acumen really right forward to the business front line. So we'll talk about that. We'll talk about the evolution and then what is changing with that role and how that impacts your students today and what it is that they need to learn and know about the marketplace. Pat and I were joking earlier that you guys have the students while they're in school and studying, and then afterwards they come to us for continued training, continued education, and continued learning. So as Pat said, we really do see this as a partnership, and we're eager to work with you. All right, real quick about AFP, Association for Financial Professionals. We are a not-for-profit working for the advancement of professionals in the Treasury and FP&A space. We do this through certifications. We have our CTP for Treasury, Certified Treasury Professional, and then for FP&A we have the FP&A certification as well. And really, these are both globally known, globally recognized, and the people who take them enjoy. They really talk about the content as well as the benefit of having the certification on their resume. We also have other continuing education. We live online webinars, we have classes. We actually hire a lot of professors to teach some of our classes as part of their consulting limelight. And then we also put on events. We have the world's largest conference for Treasury and finance professionals. This past year, pre-pandemic, we were nearly 7,000. We're working our way back there. We're almost there this year. And then we do other events for the FP&A space, and I'll just throw up one quick picture here. Just last week, we had a whole half-day webinar focused on this question of Agile, and we have arranged for IACBE members to access the playback of the recordings at no charge. We're putting it up. It'll be up in the next day or two, but then through the link you have here, and everyone's welcome to the slides. Like I said, we have arranged for your membership to attend. Real brief about me, because Pat did such a good job. I worked in industry 20 years in the office of the CFO. Currently, I create and curate content for the membership, and I also do a little bit of teaching, whether it's our workshops or at conference. And also, I'm a visiting professor of practice at Virginia Tech's Calhoun Honors Discovery Program. And then what we'll talk about today, how the CFO role is evolving, the need for Agile and why that ties in to the evolution, and then measuring and building agility. And here we'll have an opportunity to share in the research that we have and we've done, and how that might really blend into some of the things that you guys do. At any time during the talk, feel free to chime into the chat, comment on something that resonates, ask me a question. With a group that's this intimate, it's great that I can actually hear your questions right away, respond right away. And by personality, I'm informal, so I'm happy to interrupt anything I have planned, just to make this as meaningful and productive for you. All right, so we're going to start our story with the CFO here. I'm trusting that this is not anybody's student commons here. This is actually a picture of the site of Uruk. It's an ancient city. It's sometimes called the world's first big city. This is what it looks like today. And this is an artist rendition of what it might have looked like 6,000 years ago. And when I say the world's first big city, it's estimated that there were 50,000 people living here in Mesopotamia. This city is on the banks of the Euphrates River. And you can imagine that when you're building up an urban economy, there needs to be an economy, right? There's trade going on. You have craftspeople, you have farmers, believe it or not, you had government officials, and you had taxation, and people keeping records for all of that. So here is an example of how some of those first written records were actually made. People would have certain tokens that they would have if they were going to deliver it. And this kind of cuneiform tablet shows what they would do when they would deliver. They would actually press their tokens into the tablet, or they would scratch the mark in, and they were literally recording, accounting for the transactions that were going on. And this is the start of finance. And it's actually a question of which came first, the financial records or writing. This town of Uruk, fun fact, has one of the earliest written stories. The Epic of Gilgamesh comes from here, and it is dated to about the same time as these kind of financial economic transactions. So we're not ready to call them CFOs at this point. And in fact, I was really surprised when I learned that the term CFO didn't really become a term of art until the 1970s. So this graph that you see here is from the University of Chicago about the prevalence of the term CFO, or a position or a title of CFO. And it's a smallish sample size, about 400 companies that they studied. They were a subset of the S&P 500. I actually have confirmed this with a Google Ngram of how often the CFO term appeared in literature and in books, and it really mirrors this exactly. So what happened? In the early 1970s, there were some changes in accounting rules. In 1976, the SEC issued Circular 190, and then a couple of years later, FASB went and basically took these new filing requirements and changes in accounting methods and made them generally applicable, not just to financial service companies, but broadly useful. Now, the heads of companies were saying, I used to show profitability in one way. I suddenly have to show it a different way, and it looks like I'm less profitable. What does that mean? And how do I think about my business in order to make the most money, take advantage and apply these tax and accounting rules conform, right, make sure that I'm in compliance, but also run my business in the most effective way. So suddenly the CFOs were moving, the accountants were moving a little bit more forward into how the business was running. A second thing that happened was really the turmoil of the early 80s and some of the changes that were happening around inflation and market dynamics and the movement of the change of industries and where manufacturing was moving. At the time that all of these market changes were taking place, there's a great quote from Michael Eisner, and he said, I'll just read it here, of all the disciplines, whether it's operations or marketing or finance, it's the finance function that will change the most in the 80s because so many business leaders are impacted by these changes, and he specifically called out inflation. He said, until the accountants can come up with a common language, somebody must make a free translation from Greek to English to direct management on how to benefit from all these changes. Accounting is it. So he's still calling it accounting, but again, there are technical factors that are impacting the business, and finance is being called on to lead that. A third change that we see happening about this time is the corporate raiders, the barbarians at the gate, people who are coming for your company because they want to unlock financial value. They want to free trapped capital. And so companies, there are hostile takeovers, there are friendly takeovers, buyouts, LBOs, right? For those who remember, there's a lot of turmoil about who these people were coming in, kicking out management, putting their people on the board, and really overhauling the business themselves. So boards and CEOs looked around the company and they said, who do I have that can either protect me from protect us, the company, from these outside forces, or apply some of those same thinking, those same tools and mechanics of valuation, of finding where we are the most or least efficient and release that value. The CFO was thrust into that role. The next thing that I'll talk about happened in the kind of the internet era. And what we see is a focus on how you manage shareholders, especially with the story of the company, whether that's the startups that came in the 90s, the whole idea of explaining the value to your shareholders of the internet changes, the way that business is being done and the rise of venture capital and what it is that we're selling. I kind of group this together as investor relations, but now you've got the words of value coming out of the CFO's mouth to explain to your shareholders. And the last thing that I'll put on this slide is the data and digitization that really happened around the year 2000. And this is really not an event. This is something that we're still living with today, obviously, the ramifications and the impact. Obviously, the whole business is changing. Every part of the business is changing. And it makes sense that the CFO is changing as well. On this, I think about it in this way. All of us, including finance, but all of us receive new tools that we could use. There's cloud, there's mobility, processing power is dramatically increased, and not just Moore's law, but everywhere, both in core and on the edge. Well, when you have all these new tools and to do your work, what it does is it drives new capabilities. You simply can do more, different, better. And so we see this playing out in lots of different ways. We see it in RPA, robotic process automation. We see it in the rise of robots and cobots that we're working with. And obviously AI, we all know that we're not even 10 days since GPT-4 came out, right? And we're all still trying to figure out what the heck that means and how do we work with that. So we see new capabilities to allow us to do things. And then that gives rise to a new operating model. How do we deliver finance today? We've got all this new stuff. If we're delivering it the same way, well, then we're not taking advantage of it. We're not optimizing it. And that's the question of, well, what do we do? What is the role of the CFO? What do we do the same and what do we do that's different? So what I like to do is give a view of that. What's the same, what's different, and then we'll get to the new skills that are required, that your students and our working professionals are looking for. And I like to say it this way. The CFO, formerly the accountant, now the CFO, is the steward of capital in the company. And in the past, that capital meant controls around where it was, and how it's moving, right? You had your accountant in place in order to make sure you had a good control infrastructure, you could pass the audit, you could be a going concern, and the investors knew where their money was going. So what that meant was the accountants were meeting the requirements. They were making sure that they were handling their fiduciary obligations. Now, the business would look at them and say, we want you to do this at the lowest possible cost because, yes, we value the reporting, but there were investors, the regulators, the auditors. That's great. We need to do what we have to keep them happy and to stay compliant at the lowest possible cost. And so what would happen is automation always meant driving down that cost. It meant doing more with fewer people. We saw attrition coming out. And even today, we all know, we all hear about how there's not enough accountants, there's not enough financial professionals in the world. What's happening is if you are a control-focused CFO, it is narrowing the career path because what you're doing has less impact on the business, and people want the business. They want to be active, they want to be valued, they want to be doing all the growth-driven, interesting, financially rewarding parts. And so CFOs, it's important that they move beyond this narrow control focus. For us, we think about that as value creating finance. You don't give up the control part. That never goes away. It's a matter of taking those skill sets and adding on. Those skill sets are the ability to bring your finance knowledge right to the business. And what is it that we do? What is it that we in finance do? We apply our business acumen, our quantitative methods, our modeling, our understanding of how things fit into the GL, capital allocations, discounted cash flow, all of that. We bring that to bear. That's the finance acumen. The opportunity is to step out and to do it with and in partnership with the company. As we just said, there are new tools and capabilities. We're being asked to do this in a technology and data-enabled way. And as we do this, it's almost more of a consulting role. We're being asked to become the trusted advisor to the business. There's a whole set of skills that come with that, with business partnership. And what we see is if you can put all of these together, you have the opportunity to support business decisions by allocating capital to its best use. And that's what we see as the global shift. The CFO, still the steward of capital, still control focused, bringing that forward, supporting business decisions. It just so happens that by doing that, you've got a much more exciting career path to have. This is where people are moving. We have entire programs to help people transition their careers from accounting into this more forward-looking FP&A space, but not just FP&A space, it's the whole mindset of finance acumen, technology-enabled, partnership, communication, and being an advisor. So just one more note about how this role is evolving is that it's bringing about organizational changes. And what this looks like is, I'll give you this definition, right? So here's a little bit broader on what it means to be the steward of capital and how it looks in the organization. So it means that the CFO is managing the sources and uses of capital, where it comes from, how it's used, by reporting on where it was. Reporting where that was, we call that accounting, we call that audit, right? Those are the control functions. They need to make sure that all the transactions are happening, that all the interested parties are getting what they need. And there are great certifications for that. The CPA, the CIA, there's other ways to really hone your craft for that. But once you move from reporting on the sources and uses, you get to optimizing how that capital is moving around and ready for deployment. And that circulation, that movement, that preparation of your capital stack, we call that treasury and capital markets, that payment of creditors and collecting from debtors, right? For the people who owe you, we call that accounts payable and accounts receivable. That is the role of making sure that your capital is available in the right place, in the right form, at the right time, and it's ready to be given and received. And then we see this business section, this part of decision support. And this is really the emerging field of FP&A. And what we talked about before, what we do is we support business decisions to put that next dollar of capital to its most productive use. And some of the ways we do this used to belong to other parts of the business, right? Planning and budgets. People have been doing budgets for 100 years, probably, certainly longer. Actually, I think we have an example of a recorded budget from the 1400s. I didn't put that graphic up, but it's out there for you. Contact me if you want to see that. Right, we've been doing budgets for so long, but the ability to run your forecast, to align your business units on what you're doing, to manage performance throughout, this is really becoming an increasingly specialized skill set. And with that, the tools are specialized, the skills that people have, it really needs to be a separate department, because if you house that under accounting, if you house that under treasury, they have a different mindset and a different approach that's really going to be backward looking, record keeping, putting a control process on the future. And that never works, because the future never goes as planned. You can't have your budget be the limiting factor. It is a strategic plan of your aspirations. And if you have that housed elsewhere, the mindset just doesn't work. And we've seen some case studies where that just doesn't work out. All right. So I just want one quick slide just to bring it all together. There is a spectrum. The control part of the CFO doesn't go away, but now they're being asked to be on decision support. And so we're moving from control-focused finance to value-creating finance. Let me just pause here. I'm going to take a sip of water and just throw a note in the chat. Does this make sense? Does this conform with what you're seeing? Do you have any questions for me? And hello to Jeffrey from Philippines. All right, so I'm going to keep rolling then, because what we're going to talk about now is the need for agility. And I said this right up front. The CFO has the ability to inhibit or accelerate agility in the rest of the organization by what they do. Thanks, Edward. I appreciate the feedback. All right, so we talked about that. We talked about the role of allocating capital, and because of that, it's always a forward-looking exercise. What am I going to do? How's it going to change? The problem with forward-looking exercises is that, as Yogi Berra said, it's really tough to make predictions about the future. So, and why is that? Why is it hard? And why is it especially hard? Just if you could let me know in the chat whether you've heard of the term VUCA before or not. It'll tell me kind of how much depth to go into. But VUCA is a term. It was originally coined before. A strong yes from Vanessa on Deloitte, and also Paul talking about how VUCA. You guys are familiar with that, so that's great. So then I'll just touch on this lightly. Right, so VUCA is an acronym, stands for volatility, which talks about how fast things are changing. The U is uncertainty. You're unclear about where things are. The C is complexity. There's so many things happening that it's hard to know the outcome of what your actions, right? That ability to take an action and understand the reaction. And ambiguity, the lack of clarity or the meaning of an event. That's even what's going on. the VUCA framework, it's been around since the 80s. It was started at the US Army War College, now broadly used. The reason why it's so useful is it's very easy to say that things are confusing. There's lots of different, I'll take somebody else's words. There's lots of different vectors of disruption that are going on in the business world, the business environment. It's just helpful to think about where they're coming from, why they're happening, because that really allows you to focus on what you should do. Not what you should do, what you could do, what's even possible. This slide here, this came from a partner at Bain Consulting, who spoke at the event that I mentioned, Getting Agile Right. And this is just a short list of some of those vectors of disruption in the business environment. And I'm not going to read this to you because we're all living this. We all know about how markets are changing, how business is changing, how hard it is to predict, right? If VUCA is the framework for talking about uncertainty and volatility, here are a couple just really specific examples. With this, what we see is that agility is a necessity in the changing world. And people are asking CFOs to bring their methods, to bring their sources and tools to help the business be more agile. So at AFP, we talk about agility as flexibility in your operations. It's the mindset and it's the capability for action that you have. And so what we need to make sure is that we're building that into the people, to our employees, and to the students who are coming into the workforce. Why does agility matter? Here's some data from McKinsey. It was published in the Harvard Business Review, talking about companies that are resilient. And I see resilient really as the flip side of agility. Agility being the ability to take action for opportunity. Resiliency is the ability to take action in response to negative stimuli. Companies that McKinsey thinks are more resilient perform better during the downturn, they're faster into recovery, and they accelerate on that growth. Vanessa chiming in, thank you for that. That agility matters for schools as well, being able to adapt, to react to the changing educational environment and the new competitors coming into this space, and et cetera. Thank you. Agility also matters for survivability. Bain research has shown that companies that they rank as more agile simply live longer. They don't go out of business, they don't get bought out because they're in weak positions. It's just a better place to be. And from our own research, maybe it relates to the survivability and relates to performance, but in our own research, companies that are more agile reforecast faster. So they sense the market, they react to the market, and they're using better tools. Scenario planning is kind of a next stage, next in the evolution of how you make your plans. Instead of having one plan, you have multiple plans. You have multiple playbooks. And companies that responded to our survey and scored as more agile are more likely to have pre-built playbooks for different scenarios to see how the world is going to react. What you see is that they sense better and they respond better. All right, so this brings us to the next part. Sorry, I was trying to keep time there, make sure that I leave enough time at the end for questions. So the next part, we're going to talk about measuring and building agility and what that looks like and what our research has shown. And for this, I'm going to pull on research from several different areas. One is from our survey report that we had published in November, talking about measuring agility in FP&A. The second is we have a website up. It's called Finance and Accountant Careers. That's actually the name. That's the website, financeandaccountingcareers.com. And what we do here is we actually track, we look at the finance labor market and we look at wage data across the US. And for hiring managers, it makes sure that they are offering a competitive compensation for talent in the marketplace. For professionals, it also allows them to see that comp study, see the necessary skills, and help to map out different careers for themselves in the market. And then the third place that I'm going to go to share some insights is from a conversation that I had. We recently published this podcast. It's myself talking to Jim Washam, who's the dean of the business school at Arkansas State, and DJ Masson, who's a clinical professor of finance at Indiana's Kelley School. And we talked about how they're staying current. So I'll bring some of their insights in as well. All right. On the left side, you see what we call our FP&A maturity model. There's a simplified view so that we could, I don't have to go into all the detail here, but basically what it says is there are different areas where we measure agility. And in order to be agile, you have to be agile in these areas, in your financial processes, in your technology and data that's underlying your operations, and in your personal and team effectiveness, your personal skill sets. And what we found in our survey was that the biggest differentiator between those who are agile leaders, the top 20% of respondents, and everybody else, really the biggest differentiator is in that technology and data space. Here you can see the leaders are in blue, everybody else, the other 80% are in orange, and that gap, and everybody is scored on a 1 to 5 scale. That gap really is largest in the data and the technology space. What this means is that they are able to deploy systems and data more efficiently to operations and from operations. And you can see some of the areas of the biggest differentiators between those who are leaders and the core respondents. They had the tools in place, right? They had the tools that allowed for more planning, that allowed for better analysis. They were able to reconfigure and react to organizational changes. You reorg, you shift things around. Your systems are the opposite of brittle. You can come up with the new reporting. You can apply and change and figure out how to take your changes and apply that in a forward-looking way. And then access to trusted and timely data with minimal curation. And both of those are important. One is having access to data, but so often our research, common research shows that for people in finance, we are spending 50% of our time simply retrieving and putting data in a place that we could then work on it. Literally half the time spent on any attempted analysis is just getting to the point of analysis. The Bain partner I mentioned before had a great way of saying it. The challenge for businesses is to be good backstage in order to be good on stage. You can't get to all of those other things until you manage and get to that data side, the raw materials of what we work with in finance. When I spoke with DJ about this, we talked about how he's putting this into his curriculum. And so they've created what they call a corporate finance workshop. It's FP&A, but they call it corporate finance. And a workshop in Kelley parlance is a series of integrated classes all around a theme. So they had 4, this is now their 5th one that they've formed. And what they're doing is they're starting with basic finance courses. That's a given. But then they're adding not just accounting, but the business side of accounting. So they say that in order to be excellent in this area, there are certain things that are simply more important. It's the accounting specific to the business function and business costing. Then they're adding data analytics to it. And then with the analytics comes the critical thinking. How do you make decisions? What is the data telling you? What are the flaws in the data? How do you automate? How do you keep a human in the loop when you build in the automation? How do you then explain and interpret what you have, your data, to somebody who is in marketing or to your CFO or to the CEO? So this sense of how do I build data and technology? How do I be good at the basics so that I can get to the critical thinking is really important to build into his classes there. Going one level beyond that, so then the question becomes, well, what are the skills specifically that people are looking for? And when I show the charts in this format, what I'm showing you are the results our data analysis from the results of the Finance and Accounting Careers website. What we did was we looked at a basic entry-level role, finance analyst, and we looked at 64,000 jobs across America, and this was just done about 3 weeks ago. So current data, 64,000 jobs of finance analyst, which is where your students are going to be going. And we said, what are the skills that matter most? And what came out on the technical skills was data analysis, business intelligence, and data visualization. And furthermore, the data analysis was classified as growing, and the data visualization was classified as growing rapidly. This is, when we look at this, this is all those things that DJ was talking about, that our customers, the finance clients, are struggling with. How do I get from data that's separated in disparate systems, this archipelago of systems? How do I unify that and get to the point of cleaning it up so that I can make meaning from it? And then the visualization is the ability to share that meaning to the rest of the company, right? Because if you keep it to yourself, and we'll get to this in the third part, you're not performing that role of business partner in order to bring your knowledge forward to the business. I'm just laughing. I see that Edward agreeing. Quantifiable information is essential when it comes to agility, right? Being able to take that data, quantify it, present it, and share it. Jim noting the name of that workshop at Kelly. It actually is branded as the AFP Financial Planning and Analysis Workshop. Looking at that data, our website data, which comes from EMSI Burning Glass, if you're familiar, that's kind of the engine that powers it in the background. We looked at the skill cluster, and you'll notice that the scales on these are a little bit different. That's why I grouped them separately. But the skills that people are looking for, the top IT skills, separate from finance skills, the top IT skills, SQL databases and programming, right? Simply the ability to reach across, again, this archipelago of data systems in order to understand how to pull your data together, managing databases. But then, the elements that are growing quickly, it is about data management, it is about moving to the cloud, and it is about data warehousing. Just an interesting side note, one of the things that people talk about, especially when I talk to students, they kind of take for granted that everything is in the cloud, or should be, or is moving to the cloud. What we're seeing is that lift and shift to basically lifting up your in-house on-premises information and putting it in the cloud, a lot of that is being done. And now people are really figuring out how to optimize cloud operations. Because they just lifted and shifted exactly what they did, it really wasn't optimized. There's a real opportunity for finance to talk about, how are you using your cloud solution? How are you spending money? Because uniformly, people are going over budget with their cloud providers because of they're using spot rates instead of planned processing time. There's a whole development around that area. Data warehousing is just, what you see here is a sense of data fluency in order to be good at finance. Okay, Paul, I see your question there. We'll talk about what that looks like in practice. Thank you for that. All right. Here, just real quick on software, what are the tools that people are looking for? Microsoft, far and away, is still the dominant form. Excel, and this counts for basic Excel, intermediate, advanced Excel. What we see is that the world is not getting away from it. There are, I think if Excel were a language, it might be the third largest language globally. There's 750 million licenses for Excel, what we see is that it's not going away. As a software tool, it is expanding and becoming better, more connected. It has its own database connectors. It has its own ETL tools, the ability to screen scrape and take anything on the internet and ingest that. It really is becoming more sophisticated. We're also seeing it tied with a breed of tools that are acknowledging that and maximizing Excel with a database backend. And then even for companies that have left Excel, there's always the ad hoc parts. So it's not going away. It is absolutely a useful skill. Some of the other ones here, a little bit more niche, a little bit more company specific. But what we're seeing is when you know one, it's easy to know others. And again, that fluency of data manipulation, of databases is simply a requirement for getting work done today. All right, let's move on from the technology and data part to finance and business acumen. And what we measured here in our survey were the flexibility of your processes and that sensing, that ability to monitor what's going on. And what we see is that the Agile leaders, again, have processes that allow them to reforecast on demand quickly. And it's not even on demand. Paul, I'll tease my future comments. When we had our session last week, we had the head of planning, of research planning at Roche Pharmaceuticals talk about what event-driven planning looks like. And basically, the finance department works with the business to determine when to reforecast. So they're not putting artificial time deadlines and work on the business if the forecast in the business hasn't changed. Instead, they work hand in hand to know when is it useful, when does it add value, and then because of that, they have a seat at the table in terms of what's happening and the changes. Processes that take information in, here, what's different from technology, it's the ability to sense and talk to different parts of the company, the operational information and the relationship with the company. And then our own finance processes about the rigidity of budgets and how your capital and investments are working, right? On the FP&A side, we think of almost like the securities markets, we think of companies as internal capital markets that have the ability to invest across different risk assets and different maturities in order to create an optimal portfolio. The ability to rearrange that portfolio quickly is a sign of flexible processes. And then the ability to monitor, that's just knowing what's happening inside and outside your company. As far as business education, Jim Washam really stated this well. He said, in our educational components, we're just not as siloed as it used to be. It used to be you're a marketing person, you're accounting, there's X, and they were all different. But now all of these are being blended. Finance is assumed to be a part of it because everybody's asking a what if. Every question has a what if component to it. And the what if requires the financial models in order to really get through, understand, and know what to do next. Here for finance, as you'd expect, the highest number is people want to know about financial analysis. And in other research that we've done for people in the 0 to 7 range, this is what CFOs want. They want good financial analysis. They want general accounting knowledge. If you're going to be a specialist, they want specialized, but for a financial analyst, general accounting knowledge is just an essential backbone. And they want budget management. They want people who know budgets, forecasting, variance analysis, different approaches and methodologies for budget analysis. Some of the skill clusters here, this really speaks to some of the things that Jim talked about. Understanding how your business works, understanding your strategy and the linkage between strategy and your forecast and your budget. General economics, that's taking the outside world and bringing it inside and knowing how that impacts. So you've got the processes, which is your inside out, your economics, which is the outside in, your strategy that links those. And key performance indicators I thought was so interesting, especially because it's growing rapidly. That's the sense of how are you doing? I had a conversation earlier this morning with an executive from IBM, and he was talking about how the person who became their CFO is now the COO as well. And it's because the CFO is, with those new tools, has the ability to monitor more. The CFO is the steward of capital and with that comes performance management. Key performance indicators is a part of performance management. And the ability to get that right is so crucial. Some companies are moving from 500 different indicators to 5 to 7 key indicators that really help you to forecast your company. If you can run your regression analysis, look at your business, understand your operations, and find 5 to 7 drivers that influence 90% of your business, you can spend less time on the others, focus on those, be more impactful, be more agile. This is the kind of thing that we're hearing is really the cutting edge. Help us understand the data, to understand our operations, to know what hits the bottom line. That statistical acumen, the data to analyze to get there, the analysis to put it all together, all of that is wrapped up in this key performance indicators, and it's a much bigger area than the name implies. Moving on to the third area, personal and team effectiveness. The two things that are most important here are cultural mindset and your organizational design. And with the cultural mindset, what we're seeing is that Agile leaders have this belief of continual improvement, that they're always, you can call it a growth mindset. There's always more to do. There's always something new. Psychological safety is really the second part. Be able to voice what you want to say without somebody else making fun of you. It's taking a risk, right? Being able to take a risk, to respect others on your team who are taking a risk, and to support them. The organizational design, that has probably a little bit less. I wanted to share the results, obviously, but that a little bit less with how you can teach, because that's how your companies are structuring themselves, but making sure that they have the right skills and the right staffing in place. But really, the opportunity for that personal effectiveness, especially around culture, is something that can be built into the business school education. Jim talked about doing more presentations, more writing, having students lead discussions, and just more teamwork in general. Project-oriented work gives a chance to be good in a team and to support each other and to learn right from each other. DJ really echoed that. I'm putting him in teams, I'm having them do presentations, making them learn to work with each other, right? All of these things over at Kelly, they're really building in as well. Another note on change management. We asked the survey respondents, we asked the survey respondents what it is that they think about change management. And it's really that sense that change is part of the plan, that all the other tools, all the technology that's in place, they just won't get there if that idea of change isn't inherent. And so what the survey respondents want to have, and what you see in this quote from Jim, is really continuous improvement mindset is important with the technology, and that belief that the technology is going to keep changing. So as Jim says, you kind of have to be a little scared. You have to, the things that you learned 5 years ago, you have to just know that 5 years from now, it's all going to be out of date. You have to keep learning and keep growing. And whether you're doing that through certifications, through online programs, through conferences, through any of these means, what they are employing for their students, and I would implore for you and your students, is build that idea that you're not done once you graduate. The skills you have are great, they'll be in demand, but you've got to stay current. All right. We have some more time, a few minutes here at the end, so I'm happy to take questions. I'll actually take the first question that Paul asked about what does agility look like in practice? And he says, from ops and projects, it seems incremental delivery with frequent stakeholder meetings and the ability to change the plan. Is financial agility analogous to that? So Paul, I think what you're doing is you're really taking elements of the Agile manifesto, those 12 different programs, those 12 different traits of faster sprints and collaboration with the business in order to deliver small incremental bits that meet needs rather than a waterfall methodology. I actually want to share, I'll share this slide. I put it in the appendix just for a question like this one. This is some research that came from another one of the speakers at our event. And he talked about what the 8 practices, they called it nimble organizations, look like. And what I'll do is I'll just touch on what this looks like for finance. So agility means, number one, alignment, making sure that everybody is aligned. If you're in finance, this is what it means to put a budget together. The budget is your current year view of your strategic plan, and getting everybody understanding what they're doing means that they understand the aspiration of the company. The forecast then becomes your measurement against your aspirations. So agility is bringing everybody together, playing that interactive role. Number 2 and 4, that is also very much part and parcel of what we do already, clarifying decisions and defining what is viable and valuable. Anytime we put together a model that looks at, should we buy a company? Should we launch a product? Should we go into a new market, right? Those kinds of decision models are the quantitative assessment of clarifying decisions and defining what's viable and valuable. The ability to do that, to be in partnership, to be sitting with a company, right, to the business, that is exactly that Agile component of collaboration and side-by-side partnership. And that partnership then ties back to number 3, respectfully challenge and grow. There's so much emphasis on the communication, the negotiation, the influencing skills. All of these things are what people are demanding in the marketplace. And at our conference, it's funny, I could tell you, all these things are sessions that we have at conference for working professionals in order to help them get better at these. Personal communications is really hard. Effective challenge is really hard. Moving over to the right side, enable funding of outcomes and not projects. This is really hard for finance, especially because finance tends to get very micro very quickly. But ultimately, agility means not focusing as much on the tactics of how you get to your goals, but getting to the goals themselves. Another speaker gave a great example of this, the woman Svenja from Roche Pharmaceuticals. She said that they have in place a combination of 10-year aspirations and 90-day sprints. And you think, you have a 10-year aspiration, how is that agile? Well, what that means is they're not setting all new goals for the company every 12 months. They have a goal, it's 10 years, it's big, it's exciting, that's what they're aiming for. How they get there can change. And so they'll set a quarterly plan of this is what we're going to do. Okay, is it working? Do we need to make a new decision? The goal that we're aiming for is the same, but it builds into the process the ability to move money around, to move people around in order to get to that larger goal. I'll just touch on some other ones quickly. Number 6, dynamically assigned skill sets. I have only heard of one example of a company, of a finance team that really has been able to do this. This is the idea of creating very fluid teams that come together. The way this works most often is projects, cross-functional projects, the ability to work with people in different areas and bring their expertise. That's what we see in the working world. The one example I've seen where they really built it into their operations was they had certain heads of financial expertise areas, and then they had a pool of talent, and that pool of talent would be allocated to the people dynamically based on what the people want, based on the business need, the skills available, and the development opportunity for the people. That's really leading edge. Number 7 is that spectrum of maintaining flexibility and rigor. And here you have this gets to what I mentioned earlier. You have to separate out your FP&A forward-looking business partners from the people whose mindset is control and compliance. You can move them around and rotate them so that you get that experience, and that's a great way to develop people. That's the idea of corporate lattices instead of corporate ladders. That's an excellent way to do that. But structurally, if you're in a forward-looking position, you should be thinking forward-looking thoughts, not concerned about the rear view mirror. And number 8, I think is pretty obvious. Have good technology to be effective backstage. I think this will probably be the last question I have time for. Edward asks, do you think SOX will limit some of the possible decisions that would be a natural result of pushing an agility agenda? Let me just take a moment to think about that. So Sarbanes-Oxley is about making sure, is really a control function. And it has to do with, are you going through certain processes correctly? I really see that as very separate. When I worked on SOX, it really was housed in the audit part of the business. They called it enterprise risk because it sounded more exciting than audit, but it really was the audit part of the business. And it was about what controls you have in place. I actually think that it would be a best practice to have an audit methodology, or to have an audit and a risk assessment of your planning practice. I think that would be good for everybody. I think that it would help to ensure the professionalization of the planning practice, that you have people who have the right skills, that you're not just taking a random person and putting them into into this forward-looking role, that they have the right skills, they have the right training, they have the right processes, that they're going for continuing education and development. I think that it is an opportunity, and it would help the agility, because the important part of SOX is the controls to do your business. You might have to change what those controls are. You might have to build more agility into your audit plan, but that would be a separate discussion for a different group of SMEs. Dr. Simon is saying SOX is also prescriptive, and then it becomes restrictive, and it inhibits innovation, which is what agility is all about. I have heard that SOX and those controls kind of freeze where you are in place. That's why you need to have that ability to change your audit testing, your test plan. For that, you'd have to work with your outside auditors as well, and that does seem like it would be a slow-moving process, right? I don't think you could do that on a 90-day turnaround, come up with a whole new audit plan. So thank you for that insight.
Bryan, this has been amazing. I know we're at time. I feel like we could listen to you and ask questions all day, but we can't. One awesome thing though from this is for our members thinking, we got to teach to where the puck is going, right? When you have the charts with what's growing and what to do next, it's like, that's how we need to think. And I don't know, I'm just blown away by how informative and interesting this is to me, even though this is not, my wheelhouse. Here we are following along, and it all makes sense. So thank you so much for being here and doing this and sharing the information with us.
My pleasure. Thank you for the invitation, and I look forward to seeing everybody here in Orlando next month.
Wonderful. All right, everyone, have a great day.
All right. Cheers. Bye-bye.